So here in question 3, first thing we need to do is fill out this section. Situation B, assuming we're using LIFO. And so to get started, these first 3 cells, these figures are exactly the same as the figures over here, because whatever our beginning inventory cost, that's not changing. The cost of our purchases is going to be the same, and therefore the subtotal, the total cost of goods available for sale, that's also the same number. But where LIFO and FIFO are different is how we allocate this total cost of goods available for sale to ending inventory and to cost of goods sold. And I think it's easier to always figure out cost of goods sold first. And I actually would probably do this problem on paper. I think it's easier to do it on paper. Up here, I've summarized the formula that I taught you in class, and I'm using units here. I got this information from the first paragraph. So we had 800 units in beginning inventory, bought 900 more. So we had 1,700 units available that we could have sold, didn't sell 650, and these units are sitting in ending inventory. Therefore, the difference is the number of units we sold. So I like to figure out cost of goods sold first, as I said. So I'm going to figure out what did it cost us for these units that we sold. And under LIFO, we're assuming that the first units we sold are the more recent inventory purchases. So I'm going to assume we sold all 900 of the units we bought because we bought these after the units in beginning inventory. So these are more recent purchases. So 900 times the $6 price for this purchase, and that $6 was given to us over here, equals 5,400. But we can't stop there because we sold 1,050 units. So we need another 150 units. And since all of the 900 we assumed were sold, we're going to have to dig into this beginning inventory. And the beginning inventory costs $4. So the 150 times 4 is 600. And adding these together, we get our total cost of goods sold of 6,000. And we're going to go ahead and put that in this box here. So then to get our cost of ending inventory, we can get it in one of 2 ways. We can take this total cost of goods available for sale, subtract the cost of goods sold to get this number, or we can think that we had 650 units in ending inventory. Remember that we sold all the 900 that we purchased, plus 150 of these. So the remaining 650 were all units from our beginning inventory, which cost us $4. And when we multiply that out, that's how we get our 2,600. And then to finish the rest of the section, you simply subtract cost of goods sold from sales revenue to get gross profit, subtract the operating expenses to get income from operations, multiply that by 30% to get our tax, and then subtract it from the income from operations to get our net income. Then we're going to do this all over again, assuming now that our costs are falling. Because remember, in this previous example, our inventory prices were rising. They were 4, then they rose to 6. Well, now we're assuming the opposite, that the units in beginning inventory cost 6, so that would have been the amount we paid last period, and the new purchases cost $4 each. And so we actually have to fill out these rows here on our own. And so to figure the cost of beginning inventory, we're going to look up here and actually over here for situations C and D. Beginning inventory is 800 units at $6 each, or 4,800. So we put that figure here. Here are the purchases, 900 units at $4 each. So here I put in the purchases. We add them together to get this subtotal. And then we'll go ahead and use the same method that we used over here, except of course now our numbers are changing because prices are falling rather than increasing. But we'll go through the same process to figure out the cost of ending inventory under FIFO and LIFO and our cost of goods sold.